Good morning and welcome to the Killik & Co market update. Climate change is very much back on the agenda following the publishing of a letter from BlackRock's chief executive, Larry Fink. The letter highlights quite a substantial change in BlackRock's attitude towards climate change. BlackRock has previously been criticised by investors and also by the general public for not doing enough to combat climate change. As you can see from this picture here, a number of protesters camped out outside the BlackRock offices last year in order to protest against the fact that BlackRock continues to invest in companies that damage the environment, and also for the fact that BlackRock does not do more to work with the companies in which it invests in order to encourage those companies to act in a more sustainable way. Any change in how BlackRock acts could potentially be market moving given the scale of the assets under BlackRock's management. At the moment, BlackRock manages about $7 trillion worth of assets. And to put that into context, this chart here shows the market capitalizations of four of the largest companies on the stock exchange. We have Apple, $1.38 trillion, Microsoft, $1.27 trillion, Alphabet, $1 trillion, it hit that market just this week, and Amazon, $931 billion. So you can see here that, in theory, BlackRock could afford to buy all of those companies and still have some change left over. So the scale of the money that BlackRock manages really is absolutely huge. So let's have a look at an extract from this letter that was published by Larry Fink. He says that climate change is almost invariably the top issue that clients around the world raise with BlackRock. From Europe to Australia, South America to China, Florida to Oregon, investors are asking how they should modify their portfolios. They are seeking to understand both the physical risks associated with climate change as well as the ways that climate policy will impact prices, costs, and demand across the entire economy. These questions are driving a profound reassessment of risk and asset values. And because capital markets pull future risk forward, we will see changes in capital allocation more quickly than we see changes to the climate itself. In the near future, and sooner than most anticipate, there will be a significant reallocation of capital. So this really is quite a strong statement from BlackRock. It really implies that they plan to take money away from companies that damage the environment, so for example fossil fuel companies, and they plan to allocate more money towards renewable power. So this really could mean quite a significant change for the market, but we'll just have to wait and see whether BlackRock puts its money where its mouth is. And also this week, the US and China have finally signed a Phase 1 trade deal. On first impressions, the deal does look fairly basic. To put that into context, the US previously had tariffs on about $480 billion worth of Chinese imports. As part of this Phase 1 trade deal, the US will be reducing the tariffs on about $120 billion of those imports. So not eliminating those tariffs, just reducing them. So there really is quite a lot of work to be done before these overall trade issues can be resolved. But it is positive to have a start, and the market has reacted quite positively to the fact that at least something has been signed. And what's more, I think this will give President Trump something to talk about positively ahead of this year's presidential election. And finally this week, UK inflation data for December came in slightly below expectations, and that's led to a rise in the expectations of a UK interest rate cut in the next month. UK interest rate is currently at 0.75%, and there is now over a 50% implied probability that that rate will be cut to 0.5% in the next month. Let's have a look at the inflation data that has caused the market to expect this interest rate cut. This shows the CPIH, which is UK inflation data, taking account of housing costs as well. This chart shows that data over the last 10 years. The data for December came in at about 1.4%, so that was below market expectations. But what I think is more important here is the trend that you can see in this inflation data from September 2017 onwards. It really is a very clear downward line, and that really shows that demand within the UK is looking fairly weak, and you can see why market participants would be expecting a cut in interest rates in order to try and promote a bit more demand. So definitely a situation there to keep a close eye on. Moving on to the week ahead, it's very, very busy next week in terms of companies reporting, so I'm not going to go through all of these individual names, but you can clearly see on the chart here that we have got a lot of companies reporting next week. That's it from us. Have a great weekend, and we'll see you next Friday.